Joining us right now to talk market strategy is President of Bianco Research, Jim Bianco. Jim, great to have you back with us. You know, a day doesn't go by without us asking someone about a double dip. You put the odds at higher than most, 50-50. That doesn't sound good. Why?
If you break down economic numbers into three broad categories, those that lead, those that are coincident, and those that are laggards, the ones that lead, the ones that tell us where the economy is going next, are the ones that are performing worst. Those would be things like money supply, initial jobless claims, which you just mentioned, mortgage purchases, yes, even the stock market, credit spreads, and the like. As a group, they're not doing very well, and that's got me very concerned that they're pointing the way, and they're pointing the way towards an even slower economy.
So, Jim, it's Sheila Dharmarajan here. You have these odds at 50-50. What does an average investor do with their money? Would you put money in stocks right now?
You know, we've put the market as, we call it the risk-on, risk-off trade right now, because so many of the markets are correlated to each other because they're all trading off this big macro theme, whether or not we're going to have a double dip or the economy is going to speed up. I'd be in the risk-off camp right now. I don't think that there's any reason to be taking risk. I think there will be a time in the future where we could do that. So government bonds, especially short-term government bonds that will return my capital if I want to be a little bit speculative, gold along those lines. But the risk-on type of securities like stocks, corporate bonds,
but Jim,
they haven't performed this year, and I don't think they're going to continue to perform.
Jim, this is John Erlichman. You keep hearing that story from everyone, that people go into bonds and they're going into gold. I know you've talked about keeping an eye on the warnings or the encouraging comments coming out of corporate America over the next few weeks. We saw a company like General Mills this week, which is in cereals, seems like a pretty safe business, and they said we're going to hold on to our forecast, and that stock has held up well. Can't you find names in the stock market that are at least part of that risk-off category?
Yeah, I guess you can find names in the market that is, but then they would be more in the defensive areas that I would go towards. I'd go towards maybe some of the utilities, some of the higher dividend yielding stocks, because they would provide you some kind of a cushion. But if you're looking for a place to put your money to get you a strong return, this is not the market that has done it. Stock market is still down on the year as measured by the S&P 500. And I don't think it's going to be until we definitively settle the issue as to whether or not we're going to have a double-dip recession. There will be time in the future, maybe 2011, that you will be able to put the risk on trade and be able to make good returns. But now's not that time.
But, Jim, what also about some of those dividend plays? We have one guest after another saying that's where you should be allocating your money at this point.
It is a good place to allocate money right now if you had to be in the stock market, because at least you're going to get those returns. But I think it's fraught with danger, too. You're not going to get capital gains from them.
And we're talking with Jim Bianco. Jim, just a few seconds before the bell, we've seen an upward trend over the last, actually, week or so. September not looking so bad. You think this can continue? It doesn't sound so from what you're saying. Just quickly.
Yeah, the numbers are going up because the economic numbers haven't been so bad. We've been in a range since May, and we're just going to the top end of the range. So unless we break out, I think that's all it is, a revisit of the top end of the range.
Joining us right now from Chicago, John Brady, Senior Vice President of MF Global. Also with us is President of Bianco Research, still with us, Jim Bianco. But, John, I want to kick it off with you. You know, September turning out so far not to be too bad a month for stocks.
No, I think that's right, Carol. You know, pessimism had reached an extreme, specifically going into the first week of September with the heavy economic calendar. The the manufacturingism number was better than expected, and some of the details of the payroll data were better than expected. So I think we're simply just bouncing off sort of an extreme pessimistic level. You know, 1107 even in S&P futures represents the 50% retracement of your April to July equity market swoon. So it continues to be a bit of a technical trade here. We may see perhaps a stretch or reach up to 1125, 1130 in the S&Ps, let's say in the course of next week or so. But from there, I think investors will probably have to respect the range and probably lighten up a little bit. Just respect this range, let's say between 1130 and 1080 on the downside.
John's talking about going from pessimism to optimism. Well, we were talking to Jim Bianco. I got a viewer email that said, hello, what about after the election? You could see some bullishness after the election. Go back and look at what happened in 1994.
Right.
So,
hey, John, let me jump in here. You know, talk about going from pessimism to optimism. Deutsche Bank is up 0.5 point this morning. And just think, it's Deutsche Bank that's saying it may need to raise more capital. So 6 months ago, if Deutsche Bank had said we may need to raise 30% more capital, imagine what the stock would do. Now they say it, and the stock starts to rally.
It's definitely, Adam, a crazy market. Jim Bianco, it is a crazy market. This weekend we've got Basel III. We've got some developments potentially coming out over the weekend. Is that going to portend well or not so well for the financials and for the overall market climate?
I think it's going to be a bit mixed bag. Basel III is, right now we have to see how it shakes out, whether or not the Germans are going to play along with it and how much capital they have to raise, and whether or not capital raising is going to be viewed as positive or negative. Right now, we're viewing it as a bit of a negative. A year ago when we did the stress test in the United States, we viewed capital raising as positive. So it all depends on the interpretation of the news. And if I could just quickly say about the election, whether or not we're going to get a bounce after the election, I think the Republican House is already priced into the market. The difference with 94 was that was a surprise. A Republican House would not be a surprise right now, so I don't think that that would be a market-moving event. It would be a surprise if the Democrats held at this point.
You know, go ahead, Sheila.
John, it's Sheila Dharmarajan here. A quick question for you. We're getting a ton of data from China out over the weekend, particularly on inflation. How is that affecting today's trade? Do you think people are holding back a little bit because they want to see what the data says?
I think there's probably a little bit of a risk trade being taken off. You know, we did see some Chinese buying of 10-year treasuries against a 2 3/4 level in the overnight, and since then, treasury yields have moved impressively higher given the time horizon. So I do think it is a little bit wary. Traders do have it on their radar screen. We'll probably have to look at the markets early on Saturday morning and sort of digest the data. But it's tough to read too much in the tea leaves of China, simply A, because the data collection there I think is still rather suspect, and B, it's very difficult to see or think what Chinese policymakers may have up their sleeves. So it is strange, but traders don't want to get too far ahead of it and read too much into it.
All right, Jim Bianco, we're going to say thanks to you. John Brady, also out there in Chicago, thanks so much for walking us through the open here on this Friday.